I'm Brian Greer. Nice to be here with you guys. If you're not familiar with my organization, I'll give you just kind of a quick overview. But TaxConnex is a professional services firm really focused in this sales and use tax space. There's a couple of different areas where we practice and provide services to our clients. One is a compliance outsourcing service where we essentially become an outsourced sales tax department for our clients and prepare and file the returns, manage the registrations, essentially act as an outsourced sales tax resource for your business. And then we also have our consulting advisory practice where we address a lot of questions related to nexus, taxabilities, VDAs, and the like. So that's a little bit of perspective on the business. Personally, I've been in sales tax for coming up on about 25 years now, so hopefully I've got some decent experience to share with you guys here today. But a lot of times we get engaged in conversations with companies, and they want to know, well, when should I start looking at a sales tax process, or how long is this going to take? And so the idea here was just to kind of lay out some high-level perspectives and steps, but also provide kind of an overall time frame as to how long it might take to evaluate and implement some type of sales tax process. And probably similar to everything in sales tax, it's going to depend on your business, kind of where you are in your sales tax journey and what some of the potential complications are. That will dictate how long setting up a process will take for you. Could be anywhere from a month or so to 6 months or more. So the thought process here is start sooner rather than later, because you could find yourself in a scenario where there's a lot that you have to sort through, and it may take a little bit longer than you first realized. So we'll again talk about kind of those high level steps and some general time frames as to what you might expect. So the first thing is that when we start talking about a sales tax process, whether that be a new process or revamping an existing process, there's typically some type of triggering event that leads to that. And we've outlined some of those here. Of course, one of the more recent triggering events, and I say recent, it's coming up on, I guess, 5 years now, was Wayfair that probably most of you are familiar with. But new legislation, that was a big triggering event for a lot of people to look at their business, to evaluate their sales tax process, and to identify, determine if they needed to do something different. We also, outside of that, we see a lot of companies coming to us where maybe they recently acquired a division, and they're looking at evaluating the risk associated with that acquired business, so some type of M&A activity. We see companies just with a naturally expanding footprint, in terms of hiring people in new states, conducting business in additional states. But there's usually some type of triggering event where someone says, let's take a look at sales tax and really see if there's anything that we need to change or do differently from what we have in the past. So the first kind of step in all of this, and even inside this exposure review, there's several discrete steps that we look at as well. But when someone comes to us initially and with one of these triggering events, and they just want to get their arms around what their requirements are, we generally start with some type of nexus review. And I'll kind of highlight some of the different components here for you in terms of what we've operated under historically for the last 50 plus years has been a physical presence standard. So when we look at determining whether you have nexus in a state, historically, and it's still true today, it's still a component, a piece of the puzzle, we've looked at whether you have a physical presence in the state. And companies, some of that could be very obvious, where you have employees, where you have offices, maybe where you have inventory stored in a state. but also just traveling into a state can create that physical presence, whether that be a sales representative traveling into a state. It could be a service representative traveling into another state to perform some type of on-site training or installation. And it doesn't even have to be an employee. It could be a subcontractor that's creating that physical presence for you in those states as well. But there's some type of physical representation of your business in the state. Now, I referenced before the new economic nexus standards from a Wayfair perspective, which was in June of 2018. And again, most of you are probably aware of this, but what was set forth there and what we're looking at now is a little bit more of a bright line standard, whereas the physical presence standard is somewhat interpretational. The economic nexus standard is fairly clear from a state-to-state perspective. Each state's a little bit different or could be different. But for the most part, we're dealing with $100,000 of revenue sourced into a state, or 200 individual transactions or 200 individual invoices sourced into a state, either of which could create an economic presence for you in resulting in sales tax nexus. Now, what we've seen recently is some states have started to pull back on the transaction tax thresholds and are really focused more just on the revenue thresholds. But again, you also need to evaluate and determine physical presence as well as the economic presence, as the physical presence standards have not gone away. So once we've looked at physical presence, economic presence, you've got nexus in a state. Kind of the second piece here is looking at whether or not those particular states tax your revenue streams. So you see a reference here in terms of taxability of the different revenue streams. And you may have seen that similar to Nexus, the taxability can vary from state to state. Someone that's selling software as a service in one state where it's taxable, it may not be taxable in another state. Similar to other products and services, it's not consistent across the board. So once you understand where you have nexus, where your revenue streams are subject to sales tax collection, you can typically, at that point, at least estimate what your exposure is. And we want to understand what that historical exposure is before we take steps proactively to manage the process. For example, we may want to do something different in a state where we have $5,000 of exposure versus a state where we have $500,000 of exposure. But generally, this kind of initial evaluation could take anywhere from 30 to 60 days, just depending on how readily available some of the transactional data and the revenue data is accessible. But once we have completed that initial exposure review, someone has to make a decision as to what do we do about it. And oftentimes there's board members involved, executive team members involved. So the decision process in terms of presenting the findings and the recommendations is going to take another roughly month or thereabouts. What we're generally finding is there's three approaches to managing sales tax once we have identified what that exposure is. And the approach here is going to vary from client to client, and it'll depend on the materiality of the exposure. It'll also depend on some of the business objectives of the of your firm as well. For example, if you're looking to sell the business at some point in the near future, or you're seeking some type of outside financing where you're going to be subject to due diligence, you're going to be much more likely to want to mitigate that sales tax exposure so it's not an issue under due diligence in the future. If you plan on operating the business just in a kind of a go-forward basis, You have no expectation to sell the business or seek outside funding. You might be more willing to take a little bit more risk in the business and carry some of that exposure with you. So some of the options here in terms of, just register with a current period effective date and just start complying prospectively. I've got a client right now that I'm working with that they've got exposure in 14 states, I believe it is, at least a handful of those, very immaterial exposure, $5,000, $6,000, $7,000 of total even revenue in a state over a couple of year period. It's not going to be worth a lot of effort to remediate the sales tax exposure in those scenarios. So looking at a register with a current period effective date and complying prospectively might be a very fine option there. Otherwise, we could very easily spend more money in fees than the actual sales tax risk that we have over those prior periods. Another option might be to register with the correct effective date historically. The issue, and maybe not an issue there, but what will happen as soon as we use a historical date, for example, if we say January 1st of 2023, if that's the true start date of Nexus and taxable sales, we're immediately going to have to file the previous 7-8 months of sales tax returns, report all the tax due, pay a penalty, be subject to interest. So it's not necessarily the best option. Certainly in all situations, it could be an option in certain scenarios. Again, looking at, to some extent what the materiality of the risk is, because again, we could be in a scenario where the effort and the fees and the costs associated with mitigating that risk outweighs what the actual risk is itself. And then some of you may be familiar with voluntary disclosure agreements. These are formalized programs that each of the states have in place, whereby voluntarily coming forth and acknowledging to the state that we've been out of compliance, we want to get into compliance. In terms of the voluntarily coming forth, the states will typically waive all penalties, usually will not waive interest. I believe Texas is a state that waives interest, but kind of the give and take there is that you're coming forth voluntarily to report the past tax due, and the states are waiving any penalties. In addition, the voluntary disclosure, and really probably the primary benefit of the VDA is a limited look-back period. And what I mean by that is when we come forward, most states will have either a 3-year or a 4-year look-back period. So if you have 6, 7, 8 years of tax exposure and you can come forward and voluntarily report 3 years in the state that has a 36-month look-back period, in exchange for that, in addition to waiving the penalties, they'll cut off the last 5 years. Anything over that 3-year look-back period, they automatically waive. So it's a great opportunity if you have exposure that goes back a long period of time. It's not necessarily super advantageous if all of your tax exposure exists within the last year or two. So again, you have to look at what the materiality is, you have to look at what the business objectives are, and certainly whether you've collected the tax or not. If you've collected the tax, regardless, it has to be remitted. But most of the time we're dealing with and working with clients that haven't remitted the tax, and they're just looking for, what are my options to get into compliance and to manage it prospectively. So again, that's going to take some time to present those recommendations, those options, and decide how we want to clean up the historical piece of this. At the same time, as we're looking at how do we get on the right path, we also have to have a little bit of a forward thinking process as to, well, how am I going to apply the tax to the invoice? how am I going to apply sales tax within the shopping cart? So sometimes these go down somewhat parallel paths. It's not necessarily in a complete sequence the way we've outlined it here. But as we start looking at how do we apply sales tax, there's a couple of different options here as well. And again, depending on the business, depending on how many states we're in, what you're selling, how many invoices, those types of variables will often dictate which direction we go here. As an example, again, working with another client, we find out that they are in 10 states. From a nexus and having taxable sales perspective, they deal with very, very large dollar amount, but transactions or invoices, but not a lot of them. So we're looking at over the course of a year, maybe 50 or 100 invoices in these 10 different states. That fact pattern lends us to a scenario where, well, maybe we don't need to purchase any specific sales tax software here. Maybe we can just manage that within our existing accounting system. As long as we understand the taxability rules for the handful of products that we sell, and because we're dealing with a limited set of invoices, a limited number of taxing jurisdictions, we can also fairly easily identify the tax rate that applies as well. So when we're dealing with a limited number of states, a limited number of invoices, a limited number of taxable products and services, we can start to look at just leveraging our existing accounting systems. But as we progress into a business that is in every state, maybe they have hundreds of invoices a month, maybe they have a lot of different products and services with unique taxing rules, it becomes very, very difficult to manage that, out inside the existing accounting process or even inside the existing shopping cart. In those scenarios, we really have to start looking at some type of augmentation, whether it's a sales tax calculation solution specifically, or perhaps just a tax rate subscription service as well. Now, some of the more common solutions that we recommend and that we see clients utilizing, at least from a sales tax calculation perspective, include Avalara, TaxJar, Thomson Reuters, SureTax, Vertex, CiraTax. That probably covers 80 to 90% of all of the different sales tax calc engines that are in place. But they can be very effective, certainly in complex sales tax calculation scenarios. I like to think that this is probably one of the most effective areas to apply automation and technology in the sales tax process is in this sales tax calc piece of the puzzle. However, when we start going down this path, we're looking at an IT implementation. These are software solutions. And when we talk about, implementing a calc engine, it could take several months to get that set up appropriately, to make sure it's integrated with your shopping cart or with your invoicing system, to make sure all of the taxing rules are set up correctly. So it's not something that can typically be turned on overnight. It's going to take a little bit of time, but it will automate a very cumbersome part of this process prospectively. So the next piece that we have to look at is, how do we get registered and how do we set up like an actual filing process now? And this may seem like a very easy, simple process, and quite frankly, maybe at least the registration part is fairly straightforward and easy. The problem is that it can take more time than we expect. If we look at the registration piece specifically, I usually suggest a 6 to 8 week timetable to get registrations completed. Now, some states are going to be online, they're going to be instantaneous, and we can get them done very, very quickly. Other states, we're going to initiate the online application. The state's going to send a physical piece of mail to us. We're going to have to do something with that physical piece of mail and respond, provide some additional documentation. Some of the states, we're going to have a little bit of this back and forth. We also then have to set up the e-file account once we get the actual sales tax ID issued to us. So 6 to 8 weeks, maybe a little bit conservative. A lot of these can be done a lot quicker than that. And I would also say that is a good time frame to think about when we have a U.S.-based entity with a employer identification number, and when we have U.S.-based officers with a U.S. Social Security number. You see reference here to corporate officers and responsible party laws. The states are going to ask for, a corporate officer and at least one corporate officer with a social number. A lot of times businesses will push back on that from the perspective that, as an example, we're an LLC. The whole reason for setting up the LLC is to shield the corporate officers from liability. That's all fine, but if you want to get a sales tax ID number, that doesn't fly. So the states want a individual person that they can hold accountable for sales tax purposes. Now this becomes really challenging if you're a foreign-based company and you don't have an EIN and or you don't have a corporate officer with a U.S. social number. I'm not aware of any way to get a sales tax ID without a federal EIN number. So those foreign corporations are typically required to get an EIN. There are some potential workarounds for not having a U.S. Officer with a social number, but in those scenarios, we're having to provide the taxing jurisdictions still a corporate officer, but we're providing passports, so foreign passports. We're providing foreign driver's licenses. The states still want someone that they can go to directly. When we do that, that's a separate process from the online 6 to 8 week process, and it's more time consuming and difficult to get those sales tax IDs issued when you're a foreign-based corporation without the requisite U.S. corporate structure and U.S. employees. So don't overlook that piece, even though it seems relatively straightforward and easy. We also have to make sure we've got a filing process in place. Again, sometimes this is thought of kind of after the fact, or hey, it's just putting a number on a form. What could be so hard? But you got to make sure that you've got, the right data coming out of whether it's a shopping cart, whether it's an invoicing system, maybe it's both. But you got to be able to get the data out of those systems, and you have to know how to interpret that data as well. A lot of times, if you pull just a Shopify report, for example, it's not going to be really clear how you have to take that data and file it. It's going to be really easy in a state like Connecticut, where you have just a flat rate across the entire state. You just report overall revenue and overall tax. But when you get into states like California, where you have to itemize at the local level, you might be spending hours upon hours just interpreting the data. So you got to make sure you understand how that data maps to each of those individual returns. Establishing the tax calendar initially is kind of part of the registration process. So when you register, you're issued a tax ID. And what we're talking about here in terms of managing that tax calendar is just having a listing as to where you're registered and filing, but also the filing frequency, the tax ID, the method of payment, the e-file credentials to access the e-file site. And that taxing calendar could change over time. So your filing frequency could be mandated or dictated by the states to change from monthly to quarterly or vice versa. So you got to stay on top of that and manage that part of the process as well. Some of the states are going to require local reporting as well. A good example is a state like Colorado that has 73 individual home rule jurisdictions where there could be local level filings that you have to do, including or in addition to the state level return. Colorado does have a somewhat consolidated return, and I say somewhat because not all of the home rule jurisdictions participate in that consolidated return, and it's not the easiest return to file as well. So you just got to be aware of some of those states where you might have local filing requirements, and then to also make sure you have a process for managing and resolving notices. States are notorious for posting these notices on their e-file sites. So even if you use a vendor that kind of subscribes to one of these auto-file options where they take your tax data and auto-file the tax for you, they're not looking for notices in those e-file sites. A human person has to go in there and look for those and then resolve those notices if there's a question related to a return. So, but if you look at the overall time frame, you've got this initial exposure review, anywhere from a month or two. You've got another month to try to figure out, what decisions are we making? How are we going to go forward? If you go down the path of purchasing and implementing a calc engine, you could have another 2 to 3 months of setting up that calc engine. Then you've got another month or so of getting registered, setting up your compliance process. So again, this could be anything from 2 months to 6 months. And in the message we really just wanted to leave with you was get started sooner rather than later. And certainly where we are today, it's a great time to get a solution in place by the beginning of the year. So we're kind of coming up on, I guess we've got, 5 months left in the year. So if you're starting the evaluation process right now, you'll be in great shape to have a new process set up by the by the end of the year and ready to start January 1st. All right, thank you, everybody.